Hello and welcome to the Killik & Co market update. This week we've seen continued strength in the oil sector as Donald Trump has announced he's removing the US from the Iran nuclear deal. And there is a concern that sanctions imposed by the US will limit the production of oil from Iran. This will limit global supply and therefore the price of oil will go even higher. So let's have a look at what happened to the production of oil in Iran last time the West imposed sanctions. So as you can see, back in 2008, the daily production of oil from Iran was about 4 million barrels. And to put that into context, the global production of oil at the moment is about 80 million barrels of oil per day. Then as the West imposed sanctions in 2012, you can see there was a fall in production from Iran and it dropped to about 2.5 million barrels per day. And then when those sanctions were removed in early 2016, the production volume recovered fairly quickly. But there is a concern that that could easily go back the other way if Donald Trump imposes new sanctions. And then at the same time as this problem with Iran, we've also got a steep drop-off in production from Venezuela. Now, Venezuela has a huge amount of oil reserves, but at the moment the country has so little cash that it cannot afford to remove this oil from the ground. And as you can see, since 2016, there's been a fairly steep drop-off in production from about 2.4 million barrels of oil per day all the way down to 1.5 million. And there is concern that if we see further declines in production from either Iran or Venezuela, then the price of oil could go even higher. And here in the UK, the Bank of England has decided not to raise interest rates for the month of May. And this really reflects the weak data we've seen coming out of the country over the last few weeks. Because actually back in April, the data coming from the UK was looking fairly strong. Wages were up 2.8%, exports were looking good, unemployment was the lowest it had been for 43 years, and sterling was at a post-Brexit high. And back at that time, there was a 90% implied probability of having an interest rate rise in May. However, since April, the data has weakened considerably. Sterling has fallen, and more importantly, we learned that our growth rate for the first quarter was just 0.1%. So that's incredibly low, unexpectedly low, and therefore the Bank of England has decided not to raise interest rates at this time. However, the consensus is that they will still raise rates at some point over the next year. And lastly, the property company St Modwen has announced that it will be selling 2 shopping centres, one in Wembley and one in Birmingham. And this is quite interesting because it really reflects a change in the type of assets that we're seeing these property companies wanting to invest in. They no longer want to own bricks and mortar stores, they want to own the warehouses that are used for e-commerce. And you can see this by looking at the change in the portfolio composition of another property company called London Metric Property. So have a look at this chart here. The green lines show what the portfolio was invested in back in March 2016, and then the pink lines show what the portfolio held last September. So as you can see in that time frame, the investments in distribution assets, i.e. logistics warehouses, that increased from 52% of the portfolio to 67%. But the investment in retail parks, that fell from 27% all the way down to 9%. And this is a trend that we expect to continue as online shopping becomes more and more popular. Now, moving on to the week ahead, we have a real mix of companies reporting, notably Vodafone, the telecoms company, Tencent, the Chinese internet company, and Marston's, the brewery. That's it from us. Have a great weekend, and we'll see you next Friday.